for the US dollar and for global fixed income. Let's look at that right now. Bill Campbell of DoubleLine writing the following. The Fed meeting sets up more curve steepening and a weaker US dollar. Interest rates will continue to be cut with inflation under control. Bill joins us now for more. Bill, welcome to the program, sir. Let's talk about that curve steepening. So the front end story is dominated by interest rates and what the Fed does. Want your view on what's driving the long end right now and whether you and the team believe that the fiscal concerns will return?
Oh, absolutely. I don't think the fiscal concerns have gone anywhere. I think the fiscal concerns are both U.S. focused and international focused. Let's start in the U.S. We're watching for a continuing resolution to pass, but the Senate is going to need 7 Democrat votes to pass just a short-term funding resolution, and we're already seeing difficulties getting that passed. When we look, at the outlook, for the fiscal trajectory for the U.S., yes, we're going to have decent growth and hopefully, pick up further in revenues due to higher growth and tariffs. But next year's an election year, and spending, in our opinion, is likely to remain elevated. I don't think we can discount the international aspect either. We're seeing large fiscal deficits across the developed markets, from Europe, in the UK and France, to Japan, who's going into a leadership election where the candidates are focused on additional fiscal spending. Several items caught my eye, but one item that caught my eye last week was in the UK's, the Bank of England's decision to keep interest rates on hold. They made an adjustment to their balance sheet policy. They decided that they needed to slow the pace of quantitative tightening, and they're going to be adjusting their sales of longer-term assets more to shorter-term assets due to the pressures on the long end of the curve. I think those fiscal pressures across developed markets can bleed through back to the U.S., but are going to be with us across the developed markets well into next year, leading to further steepening of the curve.
Bill, there's so much to unpack there. I just want to start with what's happened over the past few weeks, which has actually been flattening. How do you understand that, given the backdrop that you just laid out?
Absolutely. I think the flattening that we've seen is a bit of a buy the rumor, sell the news on the back of the Fed. Going into the Fed meeting, there was a lot of front running, trying to think. I think a lot of investors were trying to position on how quickly the rate cutting path would come, given the downgrade in the labor market. Jay Powell, although giving us the cut, still seems to be more finely balanced. And I was actually surprised that the only dissent for an additional cut was Steve Myron. I was looking to see what Waller and Bowman were going to do, and it does not look like they dissented for a cut this time around. So I think on the back of that, the shorter term, faster trading segment of the market took some profits on the steepener. We also went through, a couple of key levels. So I think that dragged CTAs, into reducing steepener positions just a little bit. But I think as investors, what we need to do is separate out what is the medium-term trend from the short-term cyclical trading trend. If you just look very microscopically in the past couple of days, we've started to see the creeping come back into the back end of the curve, especially on the 2s, 30s, where I believe it got down to a low of 114, and now we're back up to about 117. I think that this is probably an interesting place to enter back into steepeners, as it's my opinion that fiscal concerns are going to come back to the top of the headlines, not only with the U.S. continuing resolution, but let's look at what happened in France. We are seeing protests, extremely large protests all around the expectation of, their future budget that needs to be passed in a draft format in the next week or two.
Yeah.
I think there's lessons to be learned when we look at the international markets. One of the biggest ones is this rising social unrest or rising social tensions around less fiscal space. And I believe that's going to be with developed market economies over the next, at least through 2026, if not longer. So I think we're setting up for longer term steepening of the yield curve because, one, we're going to have central banks trying to ease where they can. The Fed will be leading the way in this, but then the longer end is going to face not only fiscal pressures, but as central banks cut, trying to keep interest expense under control, that's also going to raise questions. One, about inflation expectations. What is the uncertainty around those? I think that's got to come with an increased term premium. And then we're going to have the questions about Fed credibility and Fed independence as the board, the mix of the board and potentially new members to the Fed are put in place next year.
Yeah, but Bill, some people would argue all of this does sound scary, and it sounds like it's been percolating for a while. And this was the argument earlier this year when you saw a sell-off in the long end of the yield curve. But there's more than $7 trillion in money market accounts that, as the Fed cuts, will migrate into duration, will migrate into credit, will migrate into other assets that can provide that same kind of income. Why is that wall of cash not enough of an argument to really dampen some of the steepening argument?
Well, I think the wall of cash is likely to go more into where we're focusing on, in the belly or front end of the curve, into credit markets and into international markets as well. There are other places besides the long end of the yield curve to put your money. And when we look at what happened post-Liberation Day with the correlations between equities and risk assets and the long end of the curve, I think that is something that a lot of institutions and institutional investors have taken note of. So I think that the fact that the Fed is continuing to lower interest rates, we're probably extending the path of a continued, let's call it, positive economic outlook with a backdrop that is probably good for risk. And that, I think, in my opinion, should support the trade for emerging market local currencies and local bonds. I think when we look at DoubleLine across all of the different sectors, we notice that valuations are tight pretty much everywhere except for that area of the market. And we're finding opportunities to pick up yield and to participate in uncorrelated returons by allocating to the larger, higher real yielding emerging market local currencies and local bonds.
Bill, you're giving us tons to talk about. Let's do it again soon. Bill Campbell there of DoubleLine.